Okay, so there's a couple of things we want to do in this session talking about beta. Um, One is related to operational and financial leverage, the second and third steps. So remember, when you're doing beta, you want to figure out if it's a defensive or cyclical company by looking at its revenue, what is its product, who is its customers. The second thing you want to look at is operating leverage. We said operating leverage is how much fixed cost the firm has, or it might be a measure of the elasticity of demand for their product. We said we're going to do that by looking at the standard deviations of their margins. And then the last one is looking at the financial leverage, is how much debt the firm has. There's a file on Blackboard under files for papers. You look for paper 3 and 4. It's the very last file. It's the Bloomberg data. Bloomberg data to help you with beta. When you load the file, this comes up, and I have Costco loaded. So you notice in the formula, it's doing equal pace values. Pace value is the second sheet. You just go and find the ticker for the company you're doing. So here I have Costco loaded, and it has three things in here: the debt to equity of the firm, the standard deviation, their gross margins, which you can ignore in paper 3 if you'd like. I just have it here just in case, but you definitely want to have the standard deviation of the net margins. So let's start with the margins. Remember, my argument was firms with inelastic or elastic demand for their product and high fixed costs should have volatile gross margins if their demand is very elastic, and they have higher fixed costs and elastic demand for products. Their net margins should be very high standard deviation. And so what I did here is in the first column I have the S&P 500. That's the market. You can see the typical firm in the S&P 500. Their gross margins have a standard deviation of 3.81%. Now be very careful in your paper. This is not the gross margin of the firm. This is the standard deviation of gross margins. So for the S&P 500, the standard deviation of a typical firm, this is the median. 50% of the firms are higher than this and 50% lower. The median is 3.81%. For net margin, the median is 6.25%. And you would expect net margins to be somewhat more volatile than gross margins. I also give you the 90th percentile and the 10th percentile. And there's where you really see a lot of volatility. And then I bring in Costco. Well, Costco, demand for their product is very inelastic because people know if they're going to be buying coffee or bananas or sodas, the price is going to go up and down with whatever the market is, and people will substitute things. But Costco has very, very stable net margins and gross margins. They're out of 500 companies, they rank at 1%, so they're in the top 5 or 6 companies. And for net margins, even more impressive, Costco has one of the most consistent net margins in the industry. I don't know who's ahead of them. They're ranked 0.3%, so there must be one firm ahead of them. I don't know who that is, but extremely stable margins. I can see with gross margins a firm being very, very stable, but to have a 0.2 standard deviation of net margins is just absolutely ridiculous. Let's look at the numbers themselves. So we go to the pace values. You don't have to do this for yours, but just out of interest, I'm going to do a search for Costco. And so you see Costco, and we start off with the gross margins, and you can see 12%, 12%, 13%, really 12.5. It's 12.3, 12.5, 12.5, 12.5, 12.3, 12.3, 12.4, 12.7, 12.8, 12.6, 12.4, 12.6, 12.6, 13. That's their best one ever, and now they're 13.3, 13.3, and then 13.0. Just if you're forecasting Costco, you're not going to forecast an 8% gross margin or a 16% gross margin. And then we'll look at their net margins. That's this next set of columns. So their net margins, I'll put an extra decimal place in here just so we can see the actual numbers. But right at 3%, you can see right under 3% very consistently. There's one of the lowest, 249. but right around, and then the last few years it's been really quite much a lot better. But still, if you're forecasting the net margin for this firm, it is amazingly stable. Would not be a difficult firm to forecast. Let's compare that to, say, a Tesla. So here's Tesla's. You can see that their gross margin went from 88% to -8% to 9% to 26% to 30% to 7%, 23%, 28%, all over the place. The last few years it has been more stable, so forecasting going forward, you're probably in that 15 to 25% range. Look at their net margins though, just incredible. -109%, -533%, -46%, -126%. Just look at these numbers. They are getting more stable, but they're still negative. They're still losing money. I know they had a quarter there not too long ago. They actually made money. The market got real excited, but that was just one quarter. These are annual numbers, just incredibly unstable firm. And so if you like to on paper 3, you can just look at the net margin, but I like the gross margin as a good indication of how elastic the product demand is. Firms that can raise their prices along with their costs such that their margins stay very stable, that's a very interesting, very safe firm to me. And in net margins, just good indication of both the elasticity of demand and the fixed costs. You don't know which it is, but if a firm has very low standard deviation of margins, it's probably a fairly safe firm to invest in. And then financial leverage, debt to equity. This is the actual debt to equity. So the typical firm in the U.S. stock market has a debt to equity of 72%. Costco is below that at 50%, so that would mean they probably have a lower beta. Let me show you Kroger. So you just do equal, go to pace values, and you just go over to the side, and you just look for it. It's alphabetical, and you just look for the K's. Kroger's ticker is KR. We're going to drag this up to the K's. So find KR. There it is right there. There's Kroger's. And here's where I was telling you Kroger has very high debt. Their margins are very stable. You can say, as you would expect with a grocery store, they rank very high. They're not as stable as Costco, but still they rank very high. But they have very high debt. So you might look at this firm and say, wow, normally a grocery store, I might give them a 0.5, 0.6 beta. With all that debt, I might push them up to 0.7 or maybe 0.75. I don't know if I get much higher than that. But Kroger has been borrowing a lot of money, and it definitely shows. And they're not in the top, they're not in the top 10% as far as high debt, but they're getting close to that. So anyway, it's a really good spreadsheet to use. So where do we go from here? So the last one we have, remember the first one is revenue sensitivity. Is it defensive or cyclical? Then there's operating leverage. That's where you can use the gross margin and net margin standard deviation. Then there's financial leverage. That's the third way you forecast beta. That's where you look at debt to equity. And the last thing, the fourth thing we want to look at in forecasting debt to equity is just to look at their history. What you're going to do here is you're going to go to Yahoo Finance and find a firm. I have Ford Motor loaded here. So I want to look at Ford Motor. You go to the historical data, then click on the dates and go to the max, and click on the frequency and go monthly, and then click apply. So dates and do the max, frequency do monthly, and click apply, and then download it. And when you download it, it will bring in the data. It will let me go over there. Let me close this file so maybe we'll have less there. All right, so, sorry. Again, my computer has problems. All right, so when you bring in Ford's data, it comes in like this. Starts back in June 1972 and should go through March. Since March isn't over, I would go down to the very bottom. You can just do hit the control button and your down arrow, and then highlight anything that's in the current month because the current month's not over. So if you're going to do paper 3, you might have all of March but not April. So in that case, you would delete April. So get rid of that last month. Go back up to the top. And we're going to use the adjusted close. What the adjusted close does is it adjusts for stock splits and dividends and special dividends. And so it's going to give us a true total return for the company. So I'm going to delete all the columns that aren't adjusted close. So all I have is adjusted close. Now I did the same thing. Remember, it started in 6172. I have the same thing for the S&P 500. So what I want to do here is get rid of everything up to 6172. So because the S&P goes back really, really far. 6172, there it is right there. So I'm going to delete all of those rows. So now I have the S&P. I'm going to Control Shift down through February and do Control copy, go back to my Ford file, and right next to Ford, oops, I'm going to click the S&P 500. I'm then going to Control and the down arrow and just make sure they're lined up. And oops, I did something wrong. What did I do wrong? 6172. Wow. Oh no, it's right. I just, for some reason, oh. Alright, let me do this again. Sorry, I went to the wrong file. So you copy the S&P 500, make sure you're finding Ford, and up next to Ford you click Enter, click Paste. Alright, sorry guys. Control C the copy, go over the Ford, hit Enter, and nothing happens. There it goes. Alright, so sorry you're getting my errors in these videos, but it's too, given we're on such a short time frame, I can't go back and redo them, so you're stuck with that. But you can see everything lines up. So I can get rid of this column. I don't need these dates. I just brought them in to make sure I had the dates. I'm going to put Ford up here, S&P 500 here. I'm going to do Ford holding period return, S&P holding period return. You remember how to do the holding period return? You do ending market value minus beginning market value, and since income is already part of that adjusted close, we don't need that, and divide by beginning market value. Hit Enter. Here's what Ford made back in July of 1972. You can copy that over for the S&P. You highlight those two, double click on that little square on the column there, gives you Ford's returns. And now we're going to do a rolling 5-year. I used to do rolling 3-year and other videos, but because Yahoo Finance now does a rolling 5-year, I'm going to do a rolling 5-year. So let's find 5 years. So I'm going to put 1 there. And the next one I'm going to do that plus 1. So just type 1 in the first one. And then the next one, just go up to that column, up 1 plus 1. Then you can copy that down. So how many months in 5 years? 5 times 12 is 60. So we want to go down to the 60th month. And there it is. So we can get rid of everything above that. We can get rid of everything below that. And now we're going to do the rolling beta. We're going to use the slope function, equals slope. Open parentheses, you have to do Ford first. Control Shift up, hit your comma, hit your left arrow, Control Shift up on the market, close your parentheses, and there's Ford's beta for 5 years ending June 1977. You can copy that down. Then what we're going to do is we're going to do the median. The median, the 0.5%, the 90th percentile, and the 10th percentile. For that, I'm going to use the equal percentile. See that function, just type out the word percentile, open parentheses, highlight the entire range, and then comma, and go up to the 0.5. close parentheses. Go back into this formula. We always want it to be column F. So go over to the column F and put a $sign besides the F. Put a $sign besides the two F's. So you see what you have there. I'll copy this formula over so you can see it. And now that we have the F's locked in, we can copy this over. We have the 90th percent and we have the 10%. So you can see on average, forged beta has been 1.28. It has been 10% of the time as high as 2.29 or higher, and 10% of the time has been as low as 0.71. Now what we want to do, we don't want to copy this down because we want this to be the same all the way down. This is just their beta for the entire period. So I'm just going to do the equal sign and go up to that. The equal sign and go up to that. Equal sign or plus sign, either one. So that's the exact same number twice. Oops. And then I'll highlight those and copy them down. So now I have my rolling beta graph. So if you do Control Shift down and right, and highlight those 4 columns and then insert. And what you want to insert here is a line graph. So just go over to the graphs, do a line graph. And once you have the graph built, then right click and select data. And here what we want to do is we want to edit the dates. So come over here to the top of the range and go over to the dates, Control Shift down and hit enter on that and say OK. And then I would click on the y-axis, right click, and you want to format the axis. I don't want months and days. All I want is years. So go down to the very bottom, click on number, and instead of month and day, just do year, year, year. Go down to the very, very bottom, hit enter on that. You should be able to add it. I'm not seeing that for some reason. Yeah, for some reason I'm not. There it is, the add button. Sorry, there it is. Add that. And then your title, whatever company you pick. I'm doing Ford, which is not one you'd want to do because they don't have earnings that would work well for this project. But I'm going to do Ford 5-year rolling beta. I'm going to right click one more time and select data, and I'm going to give some titles to this. So the series, the first series, well, let me hit cancel, see what happened. So select data on the first series. I'm not sure why it is doing that. So what you want to do is, I'm going to actually move this to another page just so I can work with it a little bit better. Yeah, my machine is definitely having some issues. And so I'm going to right click, select the data, and hopefully it will let me edit the data. There it did that time. I'm going to do 5-year rolling beta and say OK. For the second one, it is the median. The third one is the 90th percentile. I don't care if you switch 90th and 10th. I mean, it's the 90th highest or the 90th lowest. Either is fine, but just so people know. And then the last one, we want the 10th percentile. And just clean it up, make sure everything looks good. Say OK. We lost our We lost our legend somehow, so I'm gonna, well, where is the legend? There it is. So I'll bring the legend over. You can see I'm having some definite computer issues on this machine. Yeah, it's just not letting me. So you want to drag it over. It will let you. I may have to give up on this machine. Yeah, it's not letting me, but drag it over here and extend it. Make sure it's all clear cut. It just is not going to let me do anything on this machine. So drag it over, clean it up, make sure everything looks good. Yeah, it's just amazing. I don't know what's going on, but look at the fonts. Get the fonts so that you can actually see the years. Same thing on the x-axis and y-axis. I guess it's the y and the x. And if you can somehow get it to move your legend, that would be great as well, but mine won't. So put your legend in a place so you can see it. So you can see with Ford, their beta has been pretty low in some periods of time, and you know, it makes sense that their beta was low in the 98 to 2000 because tech stocks are driving that. Here recently, it's been energy stocks and retail, so Ford's beta has come down. One thing we can check, we'll see if this would work. We go to the very, very end of our data, we can see the very last 5-year period for Ford was a beta of 1.12. So we go back to Ford and go to the summary page. Let's see if we're close to that 1.12. It may not be because they may be going into March, and March was such a volatile year that might actually have influenced it quite a bit, but we'll see. See how close it is. Yeah, it's pretty close. 1.16, we got 1.24. It should be close to this. If you follow the instructions, it should work well. So yeah, you would want to have this chart in your paper 3 as backup for your selection of beta. We'll practice that more once we get closer to doing paper 3. All right, that's it for today. For this session, we'll have one more short session to introduce the pricing of bonds, and then we'll really get into pricing of bonds.